Hello and welcome to the Financial Future Guide. I'm your guy and I'm your guide. My name is Alex and today we're doing another episode of The Market Show. Slightly different today because now we're moving towards a focus of US economy as that is predominantly where I invest my money. So we're going to look at some of the macro things going on in the US economy right now, and then we're going to get into some news sector specific first. We're going to look at oil, the oil industry, what's going on there, and one of the companies that I own within that sector. And then we're going to move on to some technology news in Facebook and in Netflix. And finally, we're going to discuss NFTs. Now, if you don't know what NFTs are, you're going to learn, and we'll get to that shortly. All right, and if you're new here, but you enjoy financial content with a focus on the stock market, go ahead and hit subscribe and make sure you check out some of the other videos on the channel. Without further ado, I'm your guy. Let's get started. First up, we're going to take a look at the US unemployment rate. We can see that in April 2020, they were up at 14.8%, which is quite significant. And since then, it's been on quite a nice downwards trend. However, once they managed to get below 7%, this had slowed down a little bit, and we're sitting at about 6.2% as of February 2021. Now, although this is a very positive trend to see, we can still see back here in March, prior to all the lockdowns, the US unemployment rate was 4.4%, so they're not quite in the clear yet and still have a little way to go. However, not to fear, the banks have started processing the $1,400 federal stimulus checks, and citizens will start receiving these as early as next week. This is part of President Biden's $1.9 trillion relief package, and the IRS announced last Friday that the third round of federal stimulus checks would go out over the next week. Anyway, this is all common knowledge, no need to spend too much time on this. Here we had the headline, "Consumers pay higher prices in February, CPI shows," as inflation keeps creeping up. US Consumer Price Index has risen 1.7% in the last year. The cost of US consumer goods and services rose in February at the fastest pace in 6 months, largely because of higher gas prices, nudging inflation closer to levels seen before the pandemic. The rate of inflation over the past 12 months moved up to 1.7% from 1.4%. And we can see from January 2017, the inflation rate was somewhere between 1.9 and 3%. However, this fell dramatically to almost zero in May 2020, and since then has been on the rise, now up at 1.676%. If you're not 100% clear on how inflation affects you, I have actually made a video on this previously when discussing interest rates, and I'll go ahead and leave that link in the description and a little pop-up on your screen now. Many economists predict the level of inflation could match or even exceed its pre-pandemic pace of 2.3% by the middle of the year. And obviously, as we know that the Fed Chair Jerome Powell has said previously that they are prepared to let prices rise above 2% for an extended period without raising interest rates. After sinking early in the crisis, energy prices have snapped back and are now higher than they were a year ago. They are likely to rise further in the months ahead as more Americans get back on the road or fly on airplanes. Production cutbacks by major oil producers are also contributing to the increase. Now that actually leads very nicely into the next topic I wanted to discuss today, which is oil. And I just want to take a second to show you this from barchart.com. And this looks at the S&P 500 broken up into different sectors and gives you an idea of how they've been performing over the last month. We can see that the S&P 500 energy has outperformed the S&P 500 significantly, up 19.65% versus the 0.22%. And these gains are also quite substantial versus the second largest move over the last month, which was financials at 10.22%. And going a little bit off topic, but we can see IT, which was the high-flying stocks for 2020, is down 5.35% in the same time period. Alright, so oil, crude prices surge as OPEC extends most oil output cuts into April. Saudi keeps voluntary curb. North American and Canadian benchmark oil prices both climb following the decision. Crude prices surged Thursday after OPEC and its allies agreed to extend most oil output cuts into April, offering small exemptions to Russia and Kazakhstan as the greatest country in the world, after deciding that the demand recovery from the pandemic was still fragile despite a recent oil price rally. OPEC's leader, Saudi Arabia, said it would extend its voluntary oil output cut of 1 million barrels per day and would decide in coming months when to gradually phase it out. Now, if you're not 100% up to date with the oil industry, Saudi Arabia voluntarily added additional cuts to their output a few months ago to help reduce the supply and push oil prices higher. So obviously this news pushed oil prices back towards their highest levels in more than a year. The price of West Texas Intermediate, which is the North American benchmark, rose, closing at 63.83 US a barrel on Thursday, up $2.55. Now, taking a look at these two charts here, they do look quite similar, but I wanted to bring this up to highlight a key point that you should be aware of. Now, what are the two charts that we're looking at here? The first here is Suncor Energy, which is a stock that I currently hold in my portfolio. And the other is the price of crude oil over the same time period. Now what you'll notice is oil has crept up to where it has been over the last 5 years, and during that time period, Suncor usually trades between $35 and $45 Canadian. So yes, Suncor has bounced back significantly from their lows. However, if oil remains at this price or continues to rise, we should expect Suncor's stock price and many other oil companies to continue this gradual move up. I currently have a price target around the $35 range where I would start looking to take some profits. And if we did make our way over the $40 mark, I would look to exit my position completely for quite a nice gain. Now there is one thing to be aware of. Suncor and many of these other energy companies did take on a lot of debt during the pandemic. And I personally don't track many of the other oil companies, but I know Suncor did make significant reductions to their operating costs. And I think this does provide Suncor with some long-term benefits that will allow their stock price to continue to rise despite taking on the additional debt. Now, closing off the oil segment of this episode, I wanted to quickly talk about the argument that I do see some people having that the oil industry is dying on its way out and we should be 100% focused on renewables. And yes, I agree that renewables should be a focus. However, we are incredibly reliant on oil for many reasons, and this is not going to be a flick of the switch transition, and it's going to take a few decades. This article here is how the fatal Texas power outage could alter the climate conversation. The energy sector leaders say reliability of electricity must be a high priority. As more countries invest in renewable energy like wind and solar, some in the natural gas sector in particular, say there is still a need for fossil fuels to ensure energy systems are robust and built with redundancies that ensure people aren't left scrambling for power if part of the system goes down. Some of you will remember that in Texas, a storm last month temporarily knocked out about half of the state's power plants, triggering outages and pushed electricity prices sky high and left dozens dead. So the global goal is still to move towards renewables. However, it's not easy to just make the switch like that. We still need reliable sources of energy. And I've talked about this before on the channel, but oil is used in so many of the things that we use. And it's so ingrained in our lifestyle, not only just from producing power. So to ensure that we do this correctly, it is going to be a long process. This article here, Facebook lets more video creators earn money as rivals race to attract social media personalities. More people will be able to earn ad revenue from live streaming videos on the platform than in the past. This is obviously a hot topic for the digital world right now, and it involves paying content creators for the content that they produce. Mark Zuckerberg and his buddies came together and they decided that they will allow content creators on its platform to earn revenue from short form videos via advertisements. This obviously comes on the back of rivals such as Snapchat, which has been paying $1 million US a day to creators who make viral short videos on its feature called Snapchat Spotlight. And Twitter also recently announced it would launch Super Follows, which would let users charge followers for exclusive content. Marky Mark and the Facebook bunch have a few ideas on how they're going to do this. They will begin testing ads that look like stickers, which content creators can use in their Facebook stories to earn money. And they also said they would give away 7 million in free Facebook stars, which users can pay to creators on Facebook Live as a form of tipping. Facebook is one of my favorite companies. They're my largest position. I love lining Mark's pockets, making sure he goes out and makes me money. And right now, I think they're incredibly undervalued. So go ahead and check out this video. I'll leave the link in the description below. Staying on the technology buzz, we have Netflix testing household verification feature for shared passwords. Some viewers are being asked to verify that they share a household with the account holder. A Netflix spokesperson says that this test is designed to help ensure that people using Netflix accounts are authorized to do so. It is currently unclear if the household verification will be implemented more widely, but the Netflix terms of service say that users of an account must live in the same household, though the company and other streaming services have declined to broadly crack down on sharing. We can see that Netflix has grown successfully from 34.24 million all the way to 203.67 million over the last 7 years. Now, if Netflix does choose to implement this, I honestly think it would have a very strong effect on the paid subscriber count. You couldn't look your financial future guide in the eye and tell me that you haven't used someone else's Netflix password previously, despite not actually paying for a paid account yourself. I think the content that Netflix is currently providing and also now producing is seen by most as an amazing library of content. I believe that many users who will be affected by this change, including myself, who despite lives in another country from my family, continues to use the shared account, I'll have absolutely no problem paying the monthly fee so I can continue to use their services. So I personally think this is a great move for Netflix. I don't currently have a position in my portfolio, however it has been on my watch list for a while now, and this is definitely a company I would strongly consider adding to my portfolio if we did have a significant pullback. Now next up, we have EHang. Many of you will recall that I actually posted a full analysis on this company, and if we take a look at the stock price, I posted the video here on the 12th of February, the day before the short seller report from Wolfpack came out, where the company proceeded to fall about 60% of its value. The stock price then bounced and then has continued a gradual downtrend since then, and in the last week did pick up slightly. Now, EHang is definitely a speculative play, but a buddy of mine did once say that if I'm going down in a flying car company, and I guess all I can really say to that is amen. Now, the Wolfpack report is shown to be full of inaccuracies, most of which have been addressed by management. EHang is clearly the first mover in this industry, with most competitors still several years away from commercialization. For EHang, commercialization is coming this year and should drive a substantial acceleration in revenue growth. Now, I'm not sure who has read the Wolfpack short report, but it was bad. They were accusing EHang of being fraudulent, that their customers weren't real, that their revenues reported were lies, and they even did things like sneak into EHang's facilities and film an empty warehouse, despite it being right before Chinese New Year and not even in the location that EHang is currently using to build their models. EHang has the only electric vehicle takeoff and landing that has been certified to fly commercially, mostly in China and Korea. As of today, EHang has conducted over 10,000 test flights in China, USA, Austria, South Korea, and has been approved for test flights in Norway and Canada. Many of these test flights have passengers, and even some carry random members of the public like reporters and local residents, and no other company has been able to do this. EHang has another big advantage: autonomy. Most of the AAV companies today require a pilot to fly, making it incredibly hard to scale operations. Pilots don't generate revenue, add weight to their aircraft, and require hundreds of hours of training. Here below we see the 24,000 square meter factory that is expected to start production in 2021. It will have an initial capacity of 600 vehicles, and this represents quarterly revenue opportunity of 45 million US, which is 4 times the current quarterly revenue. The facility will ramp up production just in time for the special certification of EHang's firefighting drone in Q2 2021, which is expected to lead to substantial orders from emergency departments. Now, if you don't know what EHang's firefighter drone looks like or what it does, it's probably one of their coolest vehicles that they're currently offering, and I do go into more detail on this vehicle specifically in my EHang analysis video. So anyway, I won't go through this whole report, but I'll leave the link in the description below. I think it's a real great read, especially for any investors or potential investors in EHang's company. I still believe in the long-term success of EHang, and their technology is honestly light years ahead of any competitors. And I'm not going to sit here and compare it to Tesla, but you never know. So I'm on board. I hold this company. I'm still down. I've actually been averaging into it over the last month. and I am aware that this is the riskiest play within my portfolio, as it is not only a very futuristic technology company, it also is a Chinese company, and that comes with its own set of risks. Now that's all for EHang. Moving on, we have NFTs, and if you don't know what it is, this digital artist Beeple created one, and it just sold for $69.3 million US. Now if you don't know what an NFT is, this summarizes it quite simply. The work is in form of a new type of digital asset, a non-fungible token, or NFT for short, meaning it is authenticated by a digital ledger known as blockchain, which certifies its originality and ownership. The tokens are used to prove that the item is one of a kind, allowing buyers to claim ownership. NFTs are aimed at solving a problem central to digital collectibles. How to claim ownership is something that can be easily and endlessly duplicated. Now, I did want to touch on this because some people are investing in these potential assets. However, is this just a clear example that we are in some kind of bubble with people purchasing things that maybe don't even really exist? Now here is an example of NFTs. This is NBA Topshot. They release packs of digital cards. Here we have a Rising Stars pack. This contains 7 moments and it costs $199 US. This is pretty similar to physical trading cards, except you own it digitally and it's more of a highlight. Now the cards work through different tiers, common, rare, and legendary, and it even tells us down the bottom here how many are made of each card. So everything is priced on scarcity. For example, some legendary cards will only have 25 original versions of it. Now obviously that means if you hold a legendary card, they're much more valuable than something like a common tier card where there's over 10,000 versions of that card. If we hit up here, we have most valuable listings, and hold on to your hat because here we have the most expensive card available on the marketplace, a Ja Morant Dunk from December 11th, 2019. This is a legendary card, so there's only 25 of them. It's a limited edition, so the count is final. There will never be more than 25 cards. And the lowest asking price on the market is $240,000 US. There are only 2 listings available, so whoever owns the other 23 are not planning on selling it at this time. And to give you a more idea of what you actually own, this is your clip right here. Alright, so it's a nasty dunk, and I hear some people say things like, well, you could go and view this on YouTube. But I would turn around and say to them, well, for other trading cards that also sell, anywhere, the physical versions, you could also go up and look for that particular photo. Like, it's nothing, what you own is not just this video, you own the exclusive right to this card. Now, I know it sounds crazy, and honestly, when I first read about it, I thought, absolutely no way, I cannot believe this is a thing. But the more I think about it, the more I can see how there is some value here. Especially for something like the NBA, you already have a very strong fan base that absorbs all sorts of content that you provide. They purchase merchandise, they wear the clothing. So it's not like you're selling a complete new item to a complete new market. This is something that you already know there is interest in. So I can understand why something like this could be popular. You may be thinking $240,000, that's absolutely ridiculous. Well, just down here we can see top sale, which means one of these has actually sold for $100,000 US. So yeah, this is NBA Topshot, one of the examples of NFTs. Maybe the prices are inflated right now, maybe they're not. Maybe we look back in 10 years and this is all dirt cheap. And before I get off the topic, Twitter boss Jack Dorsey is conducting a digital auction of his first ever tweet, which will be sold in NFT form. So this Jack Dorsey tweet got me thinking, music legend Kanye, who is an absolute menace on Twitter, what if he starts selling NFTs, essentially the rights to some of his tweets that he's originally posted, that have been controversial or somewhat entertaining? I truly honestly wonder how much one of these would sell for. Have you ever thought you were in love with someone, but then realized you were staring in a mirror for 20 minutes? I don't really know, but we may look back on this in 5 years and say, I can't believe people were buying this stuff, but also people just buy things. Like, we're consumers. We spend money on pretty much anything. So I don't know, maybe it is something. Alright, so that is all the news that I wanted to cover in today's episode of The Market Show. And I will leave you with our final segment, which is what am I looking at? And this week I'm looking at Costco, ticker symbol COST, because they have had quite a nice pullback over the last few weeks. There is definitely some opportunity there. I don't currently have a position, but I am looking to open one shortly. I've decided that that is definitely a company that I want to own, and now it's just about getting in at a reasonable valuation. I think it was my last video was a full analysis on the company, so go ahead and check that out if Costco is something that you would be interested in, and if it's not, check out the video anyway, because then it might be. The second stock that I'm watching is one that I actually already own and have a decent position in. It is CloudMD, ticker symbol DOC. Now they've had quite a nice pullback over the last few weeks. I have been adding to my position, continuing to average into the company because I think they do have some really great opportunity for long-term growth. Now this is actually another speculative play of mine, and I know that I've discussed two today, but don't be worried, your financial future guide is not taking risks. These are the only two companies that are seen as a more speculative investment. And you know me, I prefer simple, safe money that I know I'm going to get a return on and at a low risk. But anyway, that's all for today. I hope that you enjoyed this episode of The Market Show. Go ahead and hit like, comment, and subscribe to see videos similar to this one. See ya.